bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the September 24th, 2024 podcast. As our audience on YouTube can see, I'm here with my partner, Alvin Lee. Today, Alvin and I will discuss elective pay, sometimes called direct pay, which allows tax-exempt and government entities to receive a cash refund of certain clean energy tax credits. Now, elective pay was enacted in 2022 as part of the Inflation Reduction Act, which brought forth hundreds of billions of dollars worth of tax incentives to renewable and clean energy development. Now, Alvin was also on the show in August of last year, 2023, to discuss elective pay and the transferability or sale of energy tax credits. At that time, much of our discussion was speculative in nature, as we were comparing various approaches for tax exempts and governments to monetize tax credits. Now, over a year later, Alvin has better insights into how such entities are monetizing their tax credits. Now, this episode should be of particular interest to nonprofit entities, state, county, and city governments, school districts, and many other tax exempts. These are entities that are looking to install clean energy facilities that qualify for federal tax credits. Now, this episode should also be of interest to developers, contractors, syndicators, and many others who are involved in planning, developing, financing, and owning clean energy facilities. This time of year is particularly appropriate time to check back in with Alvin, as calendar year 2023 is when the elective pay provision went into effect. This means that 2024 is the first year for which tax returns can be filed claiming a tax refund for energy tax credits. Alvin and I will first discuss the elective pay provision in more detail. We'll then discuss lessons learned from the first year. We have a lot to discuss today, so if you're ready, let's get started. Alvin, welcome back to Tax Credit Tuesday.
Thanks, Mike. Pleasure to be here.
Well, it's a pleasure to have you back. Now, before we dive into this week's conversation, please share with our audience some of the many services you provide to Novogradac renewable energy clients.
Thanks, Mike. Yeah, I'm a partner here at the San Francisco office, focused primarily in renewable energy and obviously the investment tax credit. We provide audit, tax, and consulting services to our clients. This includes financial modeling, tax advisory, and planning. We're also part of our renewable energy working group, which has been diligently going through a lot of the proposed regulations related to the Inflation Reduction Act. And so if you need any of those services, feel free to reach out.
Great. Thank you for that explanation and description. As I mentioned in the intro, you were on the show back in August of 2023, and you and I discussed elective pay as well as transferability. Much of our discussion was speculative in the sense that we were working with clients and we were evaluating various approaches that tax exempts could pursue to monetize tax credits. And now that we're nearing the end of the calendar year 2023 tax filing season, we both know more about what tax exempts and governments are actually doing, the choices they're making. Now, before we start exploring that, I thought we should start with a bit of a level set for our audience. As you heard in the introduction, I noted that elective pay or direct pay allows tax exempts and government entities to file returns with the IRS where they report the energy tax credits. And since they don't pay taxes, they then have the ability to elect to receive a cash refund of those credits. So that's my simple explanation. Before we move on, do you want to build that out at all, or other points you want to make sure you make for our audience before we proceed?
No, that's very helpful. And just maybe a bit of a history lesson here. So the elective pay, or what we might refer to as direct pay, was introduced in the Inflation Reduction Act. And so prior to the IRA, a couple of things. One, the ITC was actually set to sunset in 2023. So what the IRA did was actually extend the IRA for another 10 years, or the ITC for another 10 years. And it also introduced elective pay. So prior to the IRA, the only way that you could monetize or get the benefit of the tax credit is actually we had taxes or tax liabilities, or you're partnering with an entity that could utilize those tax benefits. And so we talk about tax exempt entities or government entities, which typically don't pay any taxes. The sort of full benefit of the ITC wasn't available to them. And so the introduction of the elective pay was really to provide an additional mechanism for these entities to be able to essentially claim a cash refund in the amount of the ITC such that they can also sort of participate in the benefits of the ITC.
Great. Thank you for that. Now, when we think of elective pay and we think of this provision, I like to think that there are eligibility questions. One eligibility question is which entities are eligible for elective pay? And then the second is which tax credits are eligible for elective pay? So take either one you want first, please, and then address the other.
Yeah, so I'll address the which entities first. So typically they need to be tax exempt organizations. You would think typical sort of nonprofits, 501c corporations. In addition to that, also includes U.S. states and their political subdivisions. So this would include local, state, county, and city governments. It also includes Indian tribal governments, certain U.S. territories. And so if you fall into one of those categories, which obviously include a lot of typical entities that are tax exempt, considered tax exempt, you would be eligible for elective pay. One maybe item I would note that partnerships actually aren't eligible for elective pay. So even if multiple partners are nonprofits, the partnerships are not eligible. So what this really means is these entities would need to own the asset outright in order for them to be eligible for elective pay. And to answer your second question in terms of which tax credits are eligible for elective pay. So in total, there are 12 different credits are eligible for elective pay. The two primary ones, which most of our audience are probably interested in, is one, the investment tax credit ITC under Section 48. And it also includes the clean energy ITC under Section 48E, which will replace the ITC starting in 2025. Next, also the production tax credit, or referred to as the PTC under Section 45. And also the clean energy PTC that will replace the current Section 45 credit starting in 2025.
Great. Thank you for that. And in terms of the various entities that are eligible, school districts are also eligible. And I suspect that you're seeing a reasonable amount of activity among school districts.
Yeah, that's right. So I think school districts and a lot of is included in that sort of political subdivision definition. So yeah, I've personally been working with a lot of school districts and a lot of county and city, state, local governments as well.
Great. Now let's talk about the timeline.
Sure.
I mentioned in the introduction that calendar year 2023 was the first year where this provision went into effect, which means that the 2024 was the first filing season of 2023 returns would be filed. Can you share a little bit more about the impact of that filing season on the entities themselves that are putting these developments in service?
Yeah, for sure. So after the introduction of elective pay, the earliest system that can claim elective pay need to have in place in service in 2023. And the earliest an entity can claim an elective pay credit is if they had tax years beginning after December 31st, 2022. So 2023 would have been their first tax year that you can claim elective pay. What that generally means is for a lot of these entities that don't file, they have to file Form 990T. And so the due date for that is 4.5 months after the end of the taxable year. So really for us, the first filing deadline was May 15th this year. And so how elective pay works is you cannot unfortunately claim elective pay on a project until the tax return due date. So the earliest that you can claim is the original tax return due date. You can obviously file the tax return before that, but the actual payment will not come in until after the original filing date. So we worked on a lot of returns this year, due May 15th for December 31st year-end filers. And for a lot of government entities, they typically have June 30 year ends. So their filing deadline would be November 15th this year. So as you talk about us closing out lessons learned, we're probably a few months away from our next filing period.
Great. Thank you for that. And that also plays into the selection
Mhm.
that an entity will make in terms of going down the elective pay route, the transferring route, or the syndication route to monetize their credits. And that's what a lot of our discussion was last year in August is, when you think about elective pay, if you put a project in service in January 1 of 2023, you're not filing for the refund until May at the earliest. And then you may, and then we don't know when you'll get the actual cash refund. More about that in a moment. So that's one approach. Another approach is transferring the credit. And that should create a little bit more immediacy in terms of the receipt of the capital. And then the third, a syndicated route, is where you're not just transferring the tax credit, but you're also syndicating tax losses associated with depreciation. So I like to think of it as three choices that a tax exempt is evaluating. So can you share, and I realize that this is something that if there's a listener out there that's trying to evaluate this, they need to give you a call. It's not something you could do on a podcast because there's too many factors at play, but maybe you could at least discuss some of the many factors that come into play in choosing one of the three approaches.
Yeah, thanks, Mike. And I think in terms of elective pay, you kind of mentioned it right there. One of the main disadvantages of elective pay is that you do have to wait until sort of the following year to file the tax return and claim elective pay. In addition to sort of the delayed time of filing, you're also waiting for payment from the government as well. And there's a little bit of uncertainty on how long that may take as well to get a refund. And so looking at some of the other options out there, transferability is probably the first one that comes to mind in terms of simplicity. And for transferability, it's really a option or election to be able to sell the credit to a third party for cash payment. And so one of the advantages is you can, as soon as the credit has been generated, you can sell the credit immediately, sort of during the tax year as well, and receive cash payment for that. And it's beneficial, one, just time value of that money, but also very important in terms of when you think about financing a project and to pay for the cost, to have that available upfront is really important. In terms of sale of the credit, obviously, you're not going to be selling that for a dollar for dollar basis. So for instance, typically you might see these tax credits being sold for 90 cents on the dollar. So you might not be getting the full value of the ITC when you transfer that credit. So as a decision, when you're making a decision, you kind of have to weigh the benefits and cost of whether or not transferability might work. And then on sort of syndication, that gives a great advantage in terms of being able to monetize both the credits and the depreciation losses that comes with syndicating the asset out to a tax paying entity that can fully utilize those benefits. And so typically with tax exempt entities, since they're not being taxed, most of that depreciation wouldn't actually be used, or any benefit would come to owning the system. In terms of syndication, again, depending on the timing of financing and when syndicators can provide financing, again, you might have a more accelerated financing that which can be used to help cover the cost of the system. But that being said, obviously going down the syndication route, it's going to be probably the most complex in terms of transaction costs, time spent finding a syndicator or a partner in this case. And typically there potentially might be some minimum size of investment that these syndicators might have in terms of requirements, which create more sort of administrative and transaction hurdles. I mean, think about some of the smaller projects or nonprofits. It's going to be a market that might not be easily accessible to them without a lot of diligence. So in that sense, maybe the elective pay might be it's definitely a more simple, straightforward process in terms of filing and claiming elective pay.
Is there a rough dollar amount of ITC, of tax credits that a project or a facility would need to generate to be worth going through this syndicated route? And I know there's no set number, but if you were to think about, because when I thought about elective pay versus syndicating the losses, I think of a tax entity or a school district or something else doing a small development where it's maybe a few $100,000 of tax credits or something. And in the past, they would have been at a loss to use those, absent some sort of lease arrangement or something, but they couldn't own the facility and get the benefit of the credits themselves directly or indirectly without, in terms of like the direct pay or elective pay, they'd have to form a subsidiary entity, blah, 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 and all that would cost too much. So there is a minimum amount to go down the path of syndication. And maybe what's the smallest you've worked with roughly, would you say? In terms of,
Yeah, I mean, I think any kind of projects under 10 million would be probably a little too small. But, aside from just sizes of projects, I think when you're talking about working with syndicators, they're probably looking more sort of for repeat customers, right? Where not only are you having large enough projects, but a steady stream of projects where that relationship and a lot of the due diligence that are involved in putting together a transaction can be rolled forward, where you kind of have many, many transactions that would be able to feed into a syndicator's fund or their pipeline of projects. And so that profile might not necessarily always match up with some of the nonprofits and government entities we're dealing with. They might be looking at shorter term one-off projects that might not sort of meet that requirement as well. So another sort of consideration in terms of going down the syndication route.
that's a great point. That also, to the extent that you're a sort of smaller nonprofit, to the extent you're working with a developer, they might be taking yours and lumping in with others to meet those various size requirements and the rest. So to a certain extent, I guess it's a project might be too small individually, but depending on who you're working with in the aggregation,
That's right.
the structure can be different. I don't want to go too much into the weeds here, but he says with a giggle on his voice as we start to go into the weeds, but there is a rule about grants and ITC. And this is particularly relevant for tax-exempt entities because they often will receive cash grants from either their government agency themselves or they're receiving a grant from a government agency. Could you explain the grant rule and how that applies to elective pay at a high level?
Yeah, this rule applies only to elective pay, and essentially it's a cap on the benefit of the elective pay. So really, you have to look at any kind of tax-exempt grants or forgivable loans that are used to finance the project. And essentially the rule is the tax-exempt amount let's say it's a sort of a cash rebate. And if you add that in addition to the uh, elective pay percentage, whether it's a 30% credit or greater, it cannot exceed the total cost of the system. And so, for instance, in a very simple example, if you have a project that's 80% financed by grants and you're eligible for a 30% tax credit, that will put you 10% over the total cost of the system. And it's effectively that additional 10% would not be eligible for elective pay. So that's sort of one rule to be aware of in terms of eligibility for elective pay.
Yeah, thank you for that, Alvin. And I just would encourage our audience to reach out to you or someone else at Novogradac if you're facing this choice as to the best way to monetize the tax credits to maximize the value to the organization, because there are a lot of intricacies. Now, I wanted to switch to domestic content, and domestic content as at a very high level requirements are that a certain portion of the facility needs to contain the U.S. source content. So domestic is U.S. source content, domestic content, and the domestic content requirements started in 2024 as they apply to elective pay. So for 2023, the rules were deferred, but starting in 2024, to choose elective pay, you need to meet domestic content requirements. And I should say generally you need to, because in order to use elective pay, there is an exception to the domestic requirements rule for elective pay. So I didn't say that as artfully as I would have liked, but if you could describe what the exception to these domestic content requirements are. And then there was some recently released proposed regulations that define what a project is for this purpose. And that's caused a bit of a stir as well. So you could talk about what the exception is and then describe the stir that's been caused by the proposed regulations.
Sure. Thanks for that intro, Mike. Yeah, I think just in terms of, I want to differentiate the domestic content requirement. This is specifically for elective pay eligibility. This is different from domestic content adder, which is an additional bonus credit for meeting domestic content requirements. So effectively for elective pay, starting in 2024, the project will need to meet these domestic content requirements. And so very high level, the steel needs to be based in the US, and there's a certain threshold for manufactured components that needs to be manufactured in the United States. And so these requirements will need to be met for the system to be eligible for elective pay in 2024. And we'll want to note that this is applicable for systems that begin construction in 2024. And so if these are not met in 2024, essentially there's a haircut. And so you will only receive 90% of the elective pay amount if you don't meet the requirements. In 2025, it drops down to 85%. And then 2026, you will not receive any elective pay amount if you do not meet these domestic content requirements. That being said, there is a exception in which if the project is under 1 megawatt, it is excluded from having to meet these requirements. And so that's sort of an important exception when we're working with a lot of, for instance, government entities, school districts. Most of their systems likely will be on 1 megawatt at a very high level. And so the guidance that you kind of mentioned as well, that kind of came out with which are still in the proposed phase, but essentially provided criterion determining whether or not certain projects might be grouped together and be considered a single project, both for one, meeting domestic content requirements, but also for meeting prevailing wage and apprenticeship requirements as well. So and just to recap that briefly, Most systems, not just systems for elective pay, need to meet prevailing wage and apprenticeship requirements as well. But that also has a 1 megawatt exception. So systems below 1 megawatt don't need to meet these prevailing wage and apprenticeship requirements. So in the proposed regulation, some guidance came out that were a little bit, like you said, controversial in terms of determining whether systems meet this 1 megawatt exception. And that has to do with grouping of systems. And so what this guidance says is that if you have multiple sites or multiple facilities that are owned by a single taxpayer or entity, and they also meet 2 or more of the 7 criteria, they'll be considered a single project. And so you would add up the size of these systems and determine whether or not it crosses the 1 megawatt threshold. Now, these 7 factors are whether or not they are constructed on contiguous pieces of land, whether they're in the same power purchase agreement or offtake agreement, whether they share a common interconnection or intertie, whether or not they share a common substation, whether they share our permits, whether or not they are under a single master construction contract, and whether or not they are financed by the same loan agreement. So as you can tell, this covers a lot of different factors, and you could easily quite trigger some of these factors purely with a master contract or having a single form of financing for various sites. So for instance, you can see how maybe a school district, well, would have separate solar systems on separate schools, but because they're all financed together or they're all under a single contract, you would have to group all these different systems together. And even though individually they might not meet the 1 megawatt, if you aggregate them, they would. And so this has been sort of a hurdle in terms of understanding whether or not their systems or portfolio of systems might have to meet prevailing wage domestic content requirements. And so definitely a lot of thought has been going into whether or not these factors impact their projects, and 2, how potentially they might structure financing or their construction contracts as not to meet these factors, which would help in the 1 megawatt exception test.
Great. Thank you for that. There's lots of questions I want to dig into on that, but I won't. I'll encourage our audience to reach out to you sort of directly or someone else at Novogradac on this definition of a project and the applicability of the various exceptions and the prevailing wage and apprenticeship requirements. I did want to move on. So our partner, Tony Grapponi, was on the podcast not that long ago as part of our Renewable Energy Tax Credit Finance series. And we focused on the most recent episode on this switch to technology neutral tax credits, which you made reference to when you were describing the various credits that were eligible for elective pay. That switch is coming on January 1st of 2025. I'd encourage our audience to go back and listen to that episode. I wanted you to, once again, at a high level, share any of your thoughts on how this transition will affect elective pay.
Thanks, Mike. Yeah, I think just a quick recap of what this really means. So prior to the effective date of this guidance, the tax credit both the ITC under Section 48 or the PTC under Section 45. The credit was really determined by the type of technology that's used, which would determine eligibility. So I think solar, wind, storage, or geothermal, those types of technologies are eligible for credits. Going forward with the tech neutral guidance, really the definition of what may be eligible is expanded to any facility that is used for the generation of electricity and has anticipated greenhouse gas emissions rate that is not greater than zero. And so it turns from a technology centric definition of what's eligible to sort of a broader definition of what technology might be available. And so the purpose of this is really to allow the credit to be available for technologies that are probably newer and may potentially include technologies that haven't been developed yet. With that being said, the proposed tech neutral guidance have what you call sort of pre-qualified technologies. And so you don't need to figure out whether or not, or rather these technologies that are listed, which include solar, wind, hydropower, geothermal, as well as some others, have essentially been pre-qualified as having emissions rate that is not greater than zero. And so notably missing from this pre-qualified list is biogas. And so we know some of our clients that are working on biogas projects. There's a little bit of uncertainty on whether or not their projects will be eligible under the new tech neutral guidance. So currently, there are a lot of projects that are trying to begin construction in 2024 and therefore be sort of safe harbored into the older guidance, I would say. Now, that doesn't necessarily mean these projects wouldn't qualify under the tech neutral guidance, but there's a lot more certainty under the older guidance. And there's definitely an advantage to that certainty. And so there's definitely an incentive or push to have projects that fall into these categories to begin construction in 2024, whether by meeting the 5% safe harbor or physical work tests. So that's definitely been one of the main items that come to mind in terms of switching over to the tech neutral guidance that's coming in 2025.
Yep. Yeah, thank you for that. And that's something that I know we at Novogradac will spend a lot of time over the next few months, helping clients across all of the various renewable energy platforms and technologies going for the beginning construction this year, so they don't need to be contemplating the impact of that transition. I wanted to move now to some of the lessons learned, or some of these we kind of knew before, but so maybe it's experiences that happen as part of this filing season. And first of all, if you could do this as quickly as we can, because we're running along here on the podcast, but if you could explain to our listeners and viewers, if they're government entities or working with government entities, what they should be thinking about with respect to now having to file a return for the first time. A lot of tax exempts have been filing returns before, but a lot of entities haven't filed returns before. What should they be bearing in mind when they're filing a return for the first time?
Thanks, Mike. I think in terms of things to think about, the first thing that comes to mind is most government entities probably didn't have any filing requirements prior to elective pay. And so they're probably filing for the first time. And one of the things that's actually available for government entities to do is or the first decision is to elect a year end or a tax year end. Many government entities typically or potentially may have a June 30th fiscal year end. In addition, they may work off of a calendar year end. So with their very first filing, they can actually make an election to decide what their tax year end is going to be. Obviously, once you make that election, you can't change it unless you get approval to do so from the IRS. That being said, it matters because obviously, as we talked about before, you don't get the elective pay payment until you file your tax return. So there's a little bit of strategy in terms of when you might want to select your tax year. So in a very simple example, if you place a dozen projects in June and you don't anticipate placing into service a large number of projects for the remainder of the year, it might be advantageous to choose and elect a June 30th year end, because you would have the year ended and you could file your tax return in November of that year and potentially collect an elective payment much sooner than you would have if you elected a calendar year end, because otherwise you had to wait till the end of the full calendar year and then file a tax return in the subsequent calendar year to claim elective pay. So there is a little bit of planning involved in terms of when you expect projects to be placed into service, and that will determine which tax year you claim those credits in. And so obviously, once you make an election, you kind of have to stick with it. So maybe in the long run, it has less of an impact. But for that first filing year, it was important to understand exactly what the sort of pros and cons and the cost benefit analysis of which year end to select.
Great. Thank you for that. So this was the first filing season for elective pay, which was the first time elective pay was an option. So I know it didn't go swimmingly. Issues arose during the filing process. Maybe highlight for listeners a few of the issues that arose with this first filing season.
Yeah, I think just the filing process in general, as with any kind of tax return process, it's always probably more complex than you would think. The first thing is, in order to claim elective pay, the systems need to be pre-registered. And so there was a rollout of the pre-registration system. Once the systems have been placed in service, the taxpayer will need to go onto this website to pre-register the systems and get a pre-registration number in order to be able to claim elective pay. Overall, I think that process came out pretty smoothly. I think the initial thought was the IRS would come back with a pre-registration number in about 30 to 60 days, but we've seen pre-registration comes back number in a matter of days. And so that process seems to be pretty smooth. Obviously, with a lot of these entities, they've never filed tax returns before. And also with the introduction of the 990T, that's going to be used to claim elective pay. And just in general, there was a lot of new additional forms that came out and a lot of statements that need to go along with it in order to claim elective pay. And one other issue that kind of came up was many nonprofits are actually required to e-file their tax returns. There was a delay in terms of when for some of the tax software companies to have those forms available for e-filing. And so there's a short delay there. But hopefully, I think all of this kind of just comes with this being new for the first year, both for tax preparers, tax software companies, and the IRS as well. So looking forward to sort of a smoother process going forward as we kind of learn from this first filing season.
And leading up to filing the return, there's additional compliance steps or supporting documentation that we encourage clients to have.
Yeah.
Please share with our audience some of the additional steps and or documentation that you recommend.
Yeah, that's right. I mean, I think in general, obviously, the elective pay and the ITC is claimed through a tax return process. And so one of the items we sometimes recommend is obviously getting cost segregations to help determine eligible basis. That'll help determine the amount of the credit and the amount of elective pay. Going forward as well, for 2024, obviously we talked about meeting prevailing wage and domestic content requirements. They're going to be new for 2024. And so there's obviously documentation requirements for both in order that you would need to have in your records to be able to demonstrate that you meet these requirements. But that being said, these aren't actually things you would necessarily include in the tax return, but definitely something you should have on file. And so I know we've talked about in previous podcasts about agreed upon procedures, services that we provide in terms of assisting in documenting prevailing wage and apprenticeship requirements or domestic content requirements. So these are some of the things that might not be necessarily be in the return itself, but definitely important documentation or analyses that need to be done in order to make sure the amount of the credit or that we're claiming for elective pay is supported.
I'm going to close this portion and ask you what advice you have for those tax exempts or government agencies that will be planning on applying for elective pay next year.
Yeah, I think it's really important for a lot of these entities to, again, look ahead in terms of what kind of projects they think will have coming into service over the next year. I think it's important to think about, like we talked about, the prevailing wage requirements, whether or not they're going to meet the 1 megawatt exception. They want to sort of determine this prior to the system being complete, obviously, if they're going to need to meet certain prevailing wage requirements specifically. And then just, yeah, probably reaching out to us early in terms of a lot of the tax filing process, understanding and then deciding what year end to use, being familiar with the pre-registration process, and obviously whether or not they may potentially need a cost segregation.
Yeah, at a really high level, I sort of think of it as make sure you're getting a good tax counsel before you begin
That's right.
construction, before you begin the process, because you don't want to commit some sort of footfall that when you go to file your return later, you find that you're not eligible or you're eligible for less in credits than you thought.
That's right.
Thank you for that. And maybe one last word of advice I'd like to get from you for our audience. In addition to ensuring they're maximizing the monetization value of their clean energy tax credits, many listening probably are also interested in getting more involved in the effort to weigh in on the guidance that Treasury is issuing with respect to these various incentives, as well as to help preserve the incentives and tax credits. What advice do you have for those that are interested in getting more involved in maybe the legislative and regulatory aspects of these incentives?
Yeah, thanks, Mike. I think since the introduction of the IRA, a lot of regulations have come out. The regulations for Section 48, as well as the tech neutral regulations, are still in the proposed, or still currently in the proposed phase. And so, you know, definitely we can get involved. We have a renewable energy working group that's sort of going through the guidance as well and providing feedback. I also want to note that we have our Fall Renewable Energy Tax Credit Conference in November 7th and November 8th in Washington, D.C. So those are great ways to sort of be involved and help both discuss and provide the guidance and incentives in terms of feedback on a lot of these proposed regulations.
Yeah, I echo that. I encourage our audience to become members of the Renewable Energy Tax Credit Working Group. You can reach out to Alvin. And also, I would note that the conference in Washington, D.C. is after the election. So there'll be a lot to talk about in terms of election results and the rest. And thank you, Alvin, for being on the show today. I will include your contact information in this week's show notes. I do encourage those in our audience to reach out to Alvin if you have more questions on some of the topics we discussed today or other topics. And for those of you that do want to learn more about some of the issues we discussed today, I do direct you to the Tax Credit Tuesdays Renewable Energy Tax Credit Finance series. And we do have a dedicated playlist on your YouTube channel with all 10 of our episodes so far in the series. So you can binge watch if you like. I also encourage you to share with other members of your renewable energy finance teams our podcasts. And then before we get to the off mic section, I once again will remind our audience to please subscribe to the podcast, whatever platform you use. And also, in addition to sharing our YouTube channel, if you access the podcast through a different means, please share that with your friends and colleagues as well. Now I want to transition to our off mic section. And as regular listeners and viewers know, we use this space to give a shout out to someone working in one of the various tax credit incentives where Novogradac works. We use this as an opportunity to highlight a professional or groups of professionals who deserve recognition. And with that, Alvin, who would you like to give a shout out to?
Yeah, Mike, I don't think I have a specific individual, but overall, I think This past year, we've been so busy with a lot of the proposed regulations that's come out. I myself was able to attend various Treasury hearings during the public commentary periods. I was able to meet a lot of folks from industry, Treasury, and the IRS, all professionals and clients that are all working very hard to help further renewable energy investment and iron out the kinks, not only with the elective pay process, but just the ITC in general. And as you know, Mike, it takes a village to raise a kid. And I really feel like it's been a collective effort across the industry to get to where we are now, and looking forward to being able to participate and be part of the industry and really help further renewable energy investment going forward. So that's a quick shout out to all the folks that have been so diligent in the last year.
Well, thank you. I echo that shout out. Thank you for your diligence over these last couple of years. You mentioned earlier how regulations were issued, a lot of new regulations, and that was quite the understatement.
That's right.
There was a massive amount of regulations dealing with new technologies, dealing with new concepts of transferability, federal tax credits, dealing with new concepts of refundability of energy related or investment related tax credits. So definitely there's a lot of areas where the IRS and Treasury were treading new ground. So kudos to everyone at the IRS and Treasury and otherwise involved in that, including yourself. I appreciate you speaking at the various public hearings, advocating on behalf of clean energy incentives. So thank you again for being on the episode. It's great to have you back on the show. Hopefully you'll be back again sometime soon.
Thanks, Mike. Pleasure. And looking forward to the next time.
And to our audience, I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.